This one thing we did is going to save us over $20,000 in taxes this year. And we got a really cool short-term rental to also use too. All of that is coming up next. Welcome to Office Hours, a tax podcast by Fujikawa Associates. We're your host. I'm Josh Baldavino, one of Derek's clients, and this is Derek Fujikawa, the managing partner of Fujikawa Associates. Derek, I'm excited today. How you doing?
Good, thanks. How are you doing?
I'm good. So today we are breaking down and taking a look at what's called a cost segregation study for my short-term rental.
Yep.
Well, one, that entire sentence is ridiculous and long. What does a cost segregation study mean?
So cost segregation breaks out your property. So when you buy a house, there's a bunch of different components to it. If you don't do a cost segregation study, then when you depreciate your property, you would just take the full cost of the property and depreciate that over 27 and a half or 39 years, depending on the nature of the property. Versus if you do a cost segregation, then you can break out all of the individual components. And many of those components will have a shorter lifespan than 27 and a half or 39 years. And you can either depreciate them over a shorter lifespan, or if it was done in 2022 or before, the past few years when bonus depreciation was in effect, you can actually write off anything that has a useful life of under 20 years. That has, say, a 5-year or 15-year useful life, you can write all of that off. So it could create a very substantial deduction on your tax return.
So in layman's terms, and correct me if I'm wrong,
Sure.
basically a real estate property is a business, whether it be a
Mhm.
long-term rental or short-term rental, because there is business and there's a building and things inside the building, some of those things break. And basically you can divide up the value of that against any income that either is from the property or potentially from other sources, depending on the nature of the business. Is that
Yes. Yeah, for the most part, we were looking at items that have what they call IRS calls a useful life. So they're going to say degrade over time, like an appliance, right? It's going to die out at some point. So you're going to have to replace that. It lasts longer than the year that you purchase it. So you depreciate it, you expense it over its life, and then you buy a new one and expense that over its life. Again, with this cost segregation, if you don't do the cost segregation, all those items, all those small items just get lumped in with the whole property, and you're going to be depreciating your refrigerator over 39 years. And even though you're going to need to replace it at some
Yeah.
point, whereas when you do the cost segregation, you can separate it out and now expense it over its actual useful life.
So let's just take a look straight at the property that we're talking about. And this is our short-term rental that we have in Joshua Tree. And it's on Airbnb right now. So if you're looking for a short-term rental in Joshua Tree, let me know. But what we basically did is we bought the house, we furnished it. And now at this point, we hired another engineering firm, Madison Specs, to do our cost segregation study. And they itemize everything, like so much. Even they itemize what we bought it as before and then added in the improvements we made. So, for example, the backyard. We didn't have this wooden fence with this see-through cable looking on the backside. It was just a chain link fence. And because we bought it with the chain link fence and we made improvements to that, both of those were technically ours at one point when we put this property into service. And so that went into the calculations, which you'll see. But all the furniture, floors, they literally pick everything because everything is part of the business.
Yes.
And so we sent them a very detailed list of how much we spent for furnishings and rehab. And they had some additional questions. And at this point, they have gone through and made a really thorough report. So why this is significant, Derek, is because on short-term rental side, I guess from what I know is it is now an active business if I'm the active manager and material participating.
Yes.
So what does material participation mean?
So you do need to materially participate, but it does also need to be a short-term rental. And the definition of a short-term rental is the average stay needs to be 7 days or less. So that doesn't mean that every stay needs to be 7 days or less, but the average throughout the year has to be 7 days or less. And if you meet that qualification, then if you put in at least 500 hours of work into the property, then it does qualify as really participating. Another rule is if, say, you buy it towards the end of the year, if you put in 100 hours and more than anyone else, then you can also qualify as materially participating. So either one of those two qualifications will work.
So at this point, we have logged our hours. We have a list of how long everyone has stayed, and it is definitely under 7 days in Joshua Tree,
Mhm.
that's for sure.
Sure.
And we hired this firm to run this study, which was about for us was $3,000. And gosh, okay, I'm excited to speak in this with you because to be honest, I didn't look at it myself.
Sure.
It's all because I think that you would know more how to read this than I do.
Sure.
Okay. So this is our actual study for our house. This is the front of our
Mhm.
house. And there's a summary page on page 13. So what are we looking at here?
So this is where it breaks it down into those different categories. So on this $400,000 house, if that was your purchase price, and you have to separate out land. Land is not depreciable. So in this instance, they took out 25%. So that $100,000 will not be depreciable, regardless of if you do the cost segregation or not. So that you just take off the top. And now the remaining 300,000, if you did no cost segregation, you would just divide that by 39 years and take that as your annual depreciation every year. Now, with the cost segregation, now, as you can see here, there's two additional lines, right? So you had that 39-year property, that's 222,000 and change there. But now you have the two separate lines below it, the land improvements and personal property. Those are the items that they pulled out of the entire property and allocated to those items with the lower life. And those are the ones that we can depreciate faster or potentially take bonus depreciation. And since it was purchased in 2022, we can bonus 100% of those costs against your rental income and your other income now that since it's an ordinary business.
Yes. So the goal for us really to do this was both we have normal W-2 jobs and with the short-term rental, it's an active business. We were trying to offset our income and how much we would pay in taxes from these different endeavors. So ideally, we could potentially get 77 or so, but let's look at how these numbers were calculated. So that's a nice summary
Sure.
page. And then summary of cost by assets. I guess what are we looking at here?
So now, as you can see, like we mentioned, they're pulling out all the individual items. So you have cabinets, flooring, landscaping, all these different individual items. They're pulling those out. And this is the detail of that $77,000, all of the different components that make up that $77,000 of items that were pulled out.
Okay. So this is the really macro perspective. And then this page here ends up being a little bit more zoomed in.
Yep.
I guess quick context for the viewers. For Madison Spec, we paid them a fee to run the study for us. We gave them all the purchase documents, what improvements we made, how much we spent on rehab. We also gave them a list of everything that we did to furnish property and get it up to the rental standard. And so this report that's here is now just a summary. I mean, they actually went in and valued I would not even look at the different types of end roofing and framing, and this is all on the exterior. And there's even things for the landscaping was broken out, and concrete actually was one that I didn't even think about. Let's see here, what else is more fun? Oh, entrance door. But yeah, it's just fun to see how much detail they go into, even on the personal property for the appliances.
Yeah. They get really detailed.
Man, yeah, that's okay. So all of these now basically get lumped together back in that summary page that we had. On page 22 now, there are two different calculations here. There's one, what are we looking at here, Derek?
So this is breaking down those assets. So if you notice in the summary page, there were 5-year assets and 15-year assets, meaning that the useful life for the land improvements is 15 years, for the personal property is 5 years. So the personal property you can expense over 5 years, and the land improvements you can expense over 15 years using the depreciation rules. It's not a straight line, as you can see with the numbers there, but that's how the IRS allows you to depreciate them. But this page will show you how much you can take each year over the entire lifespan. But more importantly, over those first 15 years, how much depreciation you can take because of this cost segregation. So as you can see, yeah, you can take quite a bit in the first few years.
Okay. But the real reason why we did this was to then bonus year one.
Yes.
And 23 then shows me the difference of bonus year one and whoa,
Yeah. So
82,977.
that's where you can really see the power of this cost segregation is all that 77,000 now is an expense the year that you purchase the property. So you get that 77,000 and then also the building itself, that 222,000 and change is depreciated over 39 years. And that's where you get this 5,500 roughly of depreciation for the building itself. And you add that to the 77,000 and you have $83,000 of depreciation that can be taken against your short-term rental income, but now that it's an ordinary business, can also be taken against your other income. So wage income, investment income, any other income that you have can now offset that and really reduce your taxes.
Okay, so I know there's a lot of numbers. Really, I think the true value is like, what could this mean for somebody? This is not our scenario because we do have a business partner in this. So our situation, I think you've been following the show, is a little bit more complicated than most. But let me share screen for our spreadsheet. Okay, so this is our fictitious example. Let's pretend that the person who owns a short-term rental makes $150,000 a year from their W-2 day job. And then the short-term rental, the net income after everything was $60,000 a year. So I would effectively make $210,000. That is awesome. But it also usually means a big tax bill. What are these numbers down here?
So for simplicity's sake, we're assuming that this is the number after, say, your standard or itemized deduction. So let's just assume your taxable income is 210,000. If you did not do the cost segregation, then you would just take the total building, the 300,000, right, that was left over after you take out the land, and divide that by 39 years. So you're a little under $8,000 of depreciation for the year. And so now your taxable income is right there, that number there, and you end up paying almost $45,000 of tax on a little over $2,000 of taxable income. Quite a bit of taxes in line with the income that you made there. And again, that's just assuming no cost segregation. You're just using the regular straight line depreciation for the building based on 39 years. So this kind of gives you a baseline to see what your taxes are without that cost segregation.
Okay, so then the reason why we paid $3,000 is what's on this page here. So
Yes.
when we put in the bonus depreciation and now the numbers are different, how do these play out?
Yes. So now, as the cost segregation study showed, you can take that 82, almost $83,000 of depreciation, the bonus depreciation plus the depreciation on the remainder amount that's allocated to the house. And so you have your same $210,000 of taxable income. We subtract that bonus and regular depreciation from that. And now we're down to 127 and change on your taxable income, which now drops your income, your total tax, your total federal tax down to a little over 24,000. So we're looking at more than $20,000 in taxes saved just by doing this cost segregation this year.
And then if, for example, I already paid from my W-2 more than $25,000 in taxes, then essentially I could be getting a refund even though my income
Yes.
helped a lot.
Yeah. Even though your cash flow may have been significantly more than that, you may be getting a refund. Yes. Correct.
And this is why we paid for the cost segregation
Yes.
and
Yeah.
have Derek as our CPA because there are just tricks like these that you just don't know about until you actually know how to play the game.
Sure. Yeah, and some people will balk at the price of a cost segregation, and so you have to show them these numbers. $3,000 is a lot of money, right? If you write a check for $3,000, that's a big check. But if you're going to save $20,000 in taxes, that's more than pays for it. So it
Yeah.
really makes sense.
Well, gosh, I'm excited to see what that ends up actually netting out for us.
And we didn't even plug in state numbers, so that's an even bigger savings we can add on top of
Well,
it.
then it looks like I guess you have to like and subscribe for part two so we can go over that one. But this is fun. Yeah. For anyone who is thinking about investing in real estate, jumping into short-term rentals and wants to offset other income that they have, I don't know, this is one of the best hacks, right, Derek? This has to be one.
It is, yeah. It's a fun one too when you can show the numbers to the clients and see those numbers on paper.
Numbers are big. The asset class that you're investing in is fun because it's a short-term
Hmm.
rental and you
Hmm.
can yourself and visit yourself as you are.
Yes.
So there's just so many good benefits all around. You have any questions about short-term rentals, cost segregation, depreciation, make sure to book a call with Derek in the link down below. I know I still have a few more things I need to prepare for tax season for you, Derek,
Sure.
but this is one that I'm definitely really excited about.
Great.
But I appreciate it. Any other last closing words about cost segregations for our audience?
It's not too late. So if you bought a property last year, you can still do the cost segregation now. You'll need to do it before you file your tax return. So that's the only limiting factor. So you could always extend your return and get it done before the October 15th deadline. But yeah, it's not too late to do it if you purchased the property and closed on it last year and were able to get those 100 hours or 500 hours in on the property.
So as long as you put in the service last year and you check all the boxes, yeah, you can definitely get it done. Thank you, Derek. I'm
Sure.
excited. And if you have any questions or if you're doing your cost segregation this year too, let us know in the
Mhm.
comments. I'd love to know how much you're getting back just because
Yeah, it'd be great.
let's see. Well, thanks so much, Derek. I appreciate it. I'll see everyone on the next episode.